This is Gerald Gayton, your mortgage doctor, and I'll show you how to take the pain out of getting your mortgage. I'll put my 20 plus years of experience sharing with you insider tips to make sure that you save money and time when you get your mortgage. Now, we talked about the first part of the CADS qualifying. People always want to know, how is my interest rate determined? And so I shared with you in our last segment the C and the A, the credit and the affordability. Now we're going to talk about the down payment and the stability. So now, when you think about down payment, it's really important to know the history of mortgages, I think, in this country to understand what a down payment means. Short and simple, down payment means you're sharing risk. It used to be in the early 1900s that you couldn't get a mortgage unless you put down 50%. So if you were buying a $100,000 house, you had to have $50,000 cash in order to think about getting a mortgage. Then that mortgage was only for a year or 5 years and had to be either paid off entirely or refinanced. So you can imagine it's not difficult to see why there was not a great deal of home ownership. But with changes in the law, the introduction of the Federal Housing Administration, or FHA, things really changed and down payments went from 50% all the way down to as little as 10%. Now, before we look at today's down payments, where you can have zero down, and there are some loans where you can do that, and that's not necessarily a bad thing, I want you to think about this for a moment. Imagine that you had to loan money to someone. Six-figure check that you're going to be writing. You really don't know anything about them. You've never met them in person, and they want you to give them everything when they're asking for a loan. Now, do you think that the chances are better or worse that you're going to get your money back? That's a no-brainer, right? If the more that people have invested in it, the less likely that they are to default. And at the end of the day, all a lender really wants to do is get their money back. So when it comes to down payment, it's really about sharing the risk. So now if you want to get the best rates with less down payment, there's one way for that to happen. And that really is some kind of guarantee, other than a large down payment, that the lender is going to get their money back. And that, of course, is where mortgage insurance comes into play. And I'll do a segment about mortgage insurance as well. But if you want to qualify with the best rates, if you don't put down 20%, and I don't necessarily advocate that you do, then you're going to have some kind of mortgage insurance. If that's with FHA, you'll have mortgage insurance. If it's with USDA, etc., or a conventional loan, there will be some kind of mortgage insurance as a protection to that lender, because you're not going to be putting down 20%. So when it comes to down payment, it's all about sharing the risk. You need to figure out how much are you going to put down. Obviously, if you're going to put nothing down, it's not necessarily a bad idea. But if you put down nothing, it's going to be a little different risk scenario for a person that's going to put down 30%. So that's going to be a very important factor when it comes to determining what kind of rate you get. So that's the D, the down payment aspect of it. The last one is stability. And when it comes to mortgages, I told you with credit, everything is done over 2 years. So 24 months, we're going to look at your employment history. What kind of work have you had for the last 2 years? Is it in the same industry? Are you changing jobs? Were you a waiter, a CEO, a cook? Are you all over the map? Or have you been in the same industry for more than 2 years? What kind of story is your income saying? Is it increasing over the last 2 years? Doesn't matter if you've had several jobs. If the trend is moving up, that's a good thing. Same thing with your residential history. For the last 2 years, where have you lived? Have you lived in 5 different places? Have you lived in 2? Whatever that 2-year time frame is, or whatever is within that 2-year time frame, you have to be ready to tell the story of what's happening. So looking at your stability for the last 2 years. If you've had multiple jobs, you have to be able to tie together the story for it. If you've lived in multiple places, there has to be a reason for it. So that's the stability piece. When you put all of those together, your credit, the affordability, the down payment, and the stability, how all those come together is really going to determine what rate you can qualify for, and also what programs you may qualify for. So there's no such thing as two people getting the same interest rate. What you qualify for may be different from what I can get, and vice versa. It all depends on how those come together. This is Gerald Gayton, your mortgage doctor. I'll share my insider tips with you to save you money and time. See you next time.